Okay, so here is our fourth class, September 3rd, and we'll continue with our discussion of ethical challenges in life insurance. Um, I'll give you a personal story of a person I helped with an ethical issue she was having with a particular life insurance company. I'll try not to mention the name of the company. And then I'll end up with one of my biggest concerns with the life insurance industry related to ethics, and that's with a product called equity-linked annuities. So again, this class might step on some toes. If you work on this industry, then definitely present your side of the argument. Let me know what you think. Um, I have had there was a recruiter from Northwestern Mutual who wanted to meet with me on campus, and the first thing she said to me was, "Your students say you don't like me." And so I had to explain to her it had nothing to do with her personally. It had nothing to do with Northwestern Mutual, which is actually a fairly decent, pretty good life insurance company. It has competitive and strong products. But it has to do with these issues specifically related especially to sales practices and sales techniques that I think really raise some strong ethical questions for this industry. So let's get into this. This is a major question on the first exam, and this is all you get in the notes, as I mentioned last class. So you need, I'll try to speak real slowly and distinctly so you have time to write, but you need to flesh out your answer here very clearly. What I have here is more of an outline, a schematic, maybe makes sense for a PowerPoint. I did not want to give a more detailed, explicit answer in the notes just because I wanted you to take this information and put it into your own words. So I'm giving you the skeleton, but I'll definitely talk through in detail on this slide what my major concerns are with this industry. So the key with your answer here is the setup, why this ethical issue arose. And I'll give you my position on that, which many people in this industry have the same view. So it really comes out of the late 70s, early 80s. And then we'll walk through each one of those ethical challenges that I see in this industry. Some of them I think are more serious than others. Many of them are related to each other, you'll see. So let's start off with the history. So in the late 1970s, this is when I was leaving high school, going into college. Most of you were probably not born then. So interest rates were extremely high. And the life insurance industry had just very traditional term. We'll talk about term versus whole life. Term insurance products, very simple. Whole life insurance products, very, very simple. And they shifted from that, from a focus on just basic insurance to a focus on asset gathering. And what asset gathering means, this is very important that you get into your answer and also understand when you get into this industry, especially if you apply for a job in this industry. Asset gathering is firms like investment firms, mutual fund companies, gather assets. The reason they gather assets is because they make money as a management fee times the assets they have under management. So the amount that they're managing assets drives their income. And the life insurance industry in the past wasn't focused on gathering assets. They were focused on selling life insurance. So now they focus on being essentially investment firms and shifting away from insurance. And why did they do that? It has to do with two disintermediations that happened during the late 70s and throughout the 80s. So intermediation, an intermediary, if you think about that term, a financial intermediary is an institution like a bank, like an investment firm, like an insurance company that goes between investors and borrowers. So they collect funds and they loan them out or they invest them. So a bank will get depositors and they'll go out and they'll find borrowers, people who want to borrow money on a credit card or borrow money to buy a car or buy a house. So the bank takes our money as savers. We put it in savings accounts, certificates of deposits, checking accounts, and they take that money that we have sitting there at the bank and they'll pay us a very small return, 1-2% in today's terms, maybe not even that. And they'll turn around and they'll loan it out for someone to buy a car. And they may loan it out at 4%, and they may pay us 2%. So they make what's called a spread, 2% spread. So that's an intermediary. So disintermediation is when money moves from one type of intermediary like banks or investment firms and moves to another one. So insurance companies saw that they were being disintermediated, which means money was moving out of life insurance companies and moving to banks and to investment firms. And there's really two things driving this. Money going from life insurance companies to banks was driven by high interest rates. So life insurance companies and these traditional whole life insurance policies in the 70s, they were paying interest rates of like 3%. And people that had their products could see that, wow, they're paying me 3%, but this bank has a certificate of deposit paying 15%. And I don't lie, I actually had a bank CD that paid me 15%. I remember when I graduated from college, I was ready to move to San Antonio for a new job. And my bank said, hey, we can roll this over into a CD paying, 14, 15, 16%. I said, no, that's not a really good rate. I'll just take my money out. But yeah, 15% CD rates. Today 1 or 2% might be the norm. But back then, insurance companies were paying 3%, life insurance companies, and banks were paying 15%. And what the policyholders of these insurance products discovered was they could borrow money against their whole life policy. So their whole life policy, it might insure them for $200,000, but they might have a cash value, and we'll talk about cash value here in a little bit, might have a cash value of, say, $70,000. Well, what the insurance contract allowed them to do is they could borrow much of that $70,000 at a rate stated in the policy of saving maybe 3%. Usually the rate they're being paid of 3% was the same as the rate they could borrow the money at 3%. So essentially what they could do is they could borrow their cash value from the policy, the $70,000, at only 3%, and they could turn around and invest that $70,000 into a certificate of deposit making 15%. And as long as they paid back the life insurance loan, there was no tax consequences. It worked out pretty well. They might have to pay tax on the interest they earned on the CD, but their life insurance remains a tax-free entity. We'll talk about the taxes for life insurance here in a little bit. So now if they were to die, then the insurance company would pay $200,000 to them less. They would repay the loan, the $70,000, but the estate has the $70,000 in the CD, making 15%. So the state will get more money. So a lot of people were taking money, either borrowing money from their whole life policies, or actually just surrendering the policy, taking the cash value, and moving that money to banks because they're making much, much, much higher rates. When we talk about asset liability management later in this semester, we'll see why life insurance companies have a real struggle whenever interest rates shoot up really high and stay up really high for a while. They also struggle when interest rates are low. So we'll talk about that. Insurance companies really struggle when interest rates are volatile. So that's the first intermediation. It's money moving from life insurance to banks to get higher interest rates. So the first one is interest rate driven. The second one is the stock market driven. In the 80s, the U.S. had 2 recessions in the early 80s. The stock market did horribly in the 70s. But all of a sudden in the 80s, the stock market started taking off. And the stock market was making these average, literally 13, 14% returns. It just seemed like stocks could do nothing but go up. And so people were again taking money out of the life insurance. And this time, instead of sending it to banks, they were sending it to investment firms to invest in the stock market. So look at what the insurance company industry is going through. They have these products that are paying really uncompetitive rates. And they're seeing their money leave the insurance companies. They're taking a huge hit because they're having to sell assets to fund these withdrawals. And the assets they're selling are bonds, where the bonds they're selling are underwater because they bought these bonds yielding maybe 7%, and now interest rates are 15%. So they're selling these bonds for a large loss. They're surrendering their policies, or they're making policy loans. Either way, they have to get their hands on cash, which means they have to sell bonds that are underwater. Or they have to sell bonds to fund the stock market, insurance companies do not invest in stocks on the life insurance side, and we'll talk about why that's the case. So disaster for the industry. And the industry said, we've got to fix this problem. They could have fixed the problem like most industries do and simply shrink. There was too much capacity. The product didn't make sense given what interest rates are doing, what the stock market was doing. They should have just consolidated and shrunk and let the industry shrink down to a smaller level, but they didn't do that. They didn't want to do that. So instead of focusing on insurance, they said, we're going to change our product and we're going to become investment firms. We're going to compete with investment firms and banks and start gathering assets so we can make more money. We want to be where the game is. The party right now is in asset gathering. It's not in life insurance. People aren't thinking about life insurance because they can make so much money in the market. So how do we compete on that? So they move from a focus on insurance to a focus on asset gathering. So there's a problem with that. So the first one I talked about it, there's excess in the industry capacity. What they should have done was shrink. What they did instead was move the complexity. This term, asymmetry of information, you need to put that into your answer. It's down here again below, so I'll explain it more. But when a firm has, when an industry, the entire industry, not the company itself, the entire industry has very complex products and it's sold by really aggressive salespeople, you create a problem. The consumer is going to be ripped off because they're not going to understand what they're buying. But that's really, really key. This term complexity, make sure you highlight that term. That's extremely important in this answer. And you'll see it drives many other things here. So the industry, instead of shrinking, instead of consolidating, given that they had too many life insurance companies trying to do too much, they instead said, we'll stay in this business, but we have an advantage. We have employees that are specially trained to sell these products, and they're aggressive salespeople. And what we'll do is we'll create really complex products that are hard to understand, and we'll get these salespeople to sell them hard. And that way we can stay in this business. And the key is, why do they have to do that? And that's the letter C. So make sure you understand there is somewhat of an order in this thing. So the industry finds that it has too much capacity. It should shrink. It doesn't want to shrink. So they say, we're going to compete with the asset gatherers, but we can't. Letter C tells you why they can't. Life insurance industry is a much more expensive business than other financial services companies. So banks, investment firms, they generally save, well, banks is probably not a good example, but investment firms, they usually charge, 0.4%, 0.5%, maybe 0.7, 0.8, depends on the product, but usually less than 1% is what they charge to cover their expenses and profit. Life insurance companies charge 1.5% to 2% because they have much higher expenses. They have actuaries, they have underwriters, they have claims, they've got a big legal staff. It's a much more complicated business, much more expensive business. And so because of that, they really can't compete with this industry because they're trying to become asset gatherers. But if a mutual fund is charging 0.4% and a life insurance company is going to take off 1.8%, their products are not going to be very competitive. So how do you get away with that? How do you be in an industry where you can't compete? So you're going to move into an industry where you're asset gatherers, but you can't compete there. So how do you somehow hide the fact that your products are not as competitive as your industry, as your competitors? That your products are not as competitive, especially as with investment firms, and you hide behind complexity. And then you induce your salespeople to make the hard sales pitch, which sells commissions, which creates conflicts of interest. And this is my biggest problem with this industry. I do not think an industry that is selling investment products where they should have a fiduciary responsibility to their customers, I do not think those products should be sold with commissions. So let me give you the example of this. So think through this. You have a sales rep and they have two products they're trying to sell you. One is a very simple traditional term product, which is probably exactly what you need. The other one is one of these new complex products. And you tell that agent, if you sell the simple traditional term policy, we'll pay you a $50 commission. If you sell one of these really complex products, we'll give you a $500 commission. You might say I'm exaggerating. Just wait until we talk about equity-linked annuities. The commissions are huge. They're often 10%, which means if someone puts $500,000 in this product, the sales rep is getting $50,000 in commissions. So what is that sales rep going to do? I get $50 for selling the product the customer probably needs, but I get $500 if I sell a product that they don't need. I can probably rationalize in my mind why that second product is better for them. And so it creates, I think, insurmountable conflicts of interest. This was my debate with the lady from Northwestern Mutual. I said, I don't hate Northwestern Mutual. I definitely don't dislike you. I just do not think you'd have sales commissions. Her answer to me was, well, we've changed our sales commissions to tie it to margins. And she really wasn't understanding what I was saying. I actually just stopped complaining to her, giving my side of it, because I could tell I was just going to offend her. But to tie the sales commissions to margins, what she was saying is, the products that make our company the most money, that's where we'll pay our life insurers the most, our life insurance agents the most. The products that make our company the least amount of money, that's where we'll have our smallest commissions. Well, that's the whole problem. The agent should be focused on the best interest of their client, their customer, the policyholder. But she said their company is focused on the sales agent doing what's in the best interest of the company. So she was saying their company actually has moved to a strategy that makes this situation even worse. I might be okay with sales commissions if they were equal for all products. Companies won't do that because they make a lot less money on term than they do on these new complex products. And I'll show you that. That's why I want to show you equity-linked annuities. They're extremely profitable to the industry, but they're horrible products for their customers. So if they gave the sales commission, the same sales commission for all products, then sales agents would just sell term because that's what people need, and term is pretty easy to sell because people know they need life insurance. It's a simple product, easy to understand, but insurance companies couldn't make money if they did that. And so they changed the sales commission depending on the margins of the product. The company I used to work for, UTSA, they did not have sales commissions. My understanding is they're moving more and more to a sales commission model. That really would upset me. I'm sure glad I retired from that company. I don't know for sure if that's the case. If it is, I would be fighting hard against that. I fought very hard against them doing equity-linked annuities because I just thought it was such a horrible, horrible, horrible product. But we'll talk about that. We'll get into that. So sales commissions create conflict of interest, but you can see what the industry is setting up here. We want to be in this business of asset gathering because otherwise we've got to shrink the industry. We don't want to shrink, but we're not competitive in that market. However, we've got these sales agents that the investment firms don't have, banks don't have. We get in people's face. We sit in their living rooms. We get to talk to them one-on-one. No one's really monitoring what we're saying to them. We can probably sell some of these really complex products if we induce the sales agents to push them, because now they have an incentive to do it. The product is so complex, and that gets back, we'll get to this information asymmetries. It gives the sales agent a huge advantage because they know much more about the product than the person buying it does, and they can, since no one's monitoring them, no one's watching them, and they're induced to do the wrong thing, who knows what's going on in secret. I can say that for sure because I've actually sat through some of these sales pitches with people who did not realize I had a background in this area. It was shocking to me the things these agents say. It really does. I was tempted to call the insurance regulators on some of them. This was before iPhones, the last one I saw, so it's been several years, so maybe the world has changed. I think now they see me coming. I'll tell you, when we get to the Donya story, he certainly saw me coming, and it really helped that he knew I had a good, strong background because it let me intimidate him quite a bit. But, you know, back before iPhones, I think now if I have an opportunity, and if any of y'all have a sales pitch or a friend going to a sales pitch and they want someone like me to sit in, then let me know. I'll go in, and I don't know if you can record something like that without letting them know you're recording it, but I would sure love to record it and put it on Facebook or YouTube and just point out, maybe add some pop-up bullets that point out the deception that they're using. I know one individual, a good friend of mine, I'd recommended that they go to an investment firm, a very low cost investment firm, one that I really have a high appreciation of what they do and their model. I think they're very focused on the customer in the right way. They have the right fiduciary incentives. I recommended he go there. He did. But then a couple years later, he and his wife, I was talking to them, and he did not come back to me, but he ran into a life insurance agent, and he moved his money into the most horrific product imaginable. It's somewhat related to the equity-linked annuity. Actually, it was equity-linked life insurance, a product. It's probably the most complicated product I've ever seen. And I don't mean in life insurance. I mean in the world of any product of any company. Just a ridiculously complicated product. He was being ripped off left and right, and I'll show you why he was being ripped off. I was so sad to see he had done that. He brought me the product, and he really didn't understand the product. He thought it was an annuity or an investment of some kind. He did not realize it was life insurance. Boy, he was getting ripped off. And so I'm not even showing you a product that bad. I'm going to show you an equity-linked annuity, not an equity-linked life insurance. Horrible, horrible product. But somehow, then this is a smart guy. He's actually he has a strong finance background. He sells real estate. Hopefully he never watches this video because he'll know I'm talking about him. I didn't tell him what a bad decision he made. I just told him, yeah, I had essentially no comment. It was too late to do anything at that point. He was already in too far, although he probably would have been better off if he'd canceled and gotten back out. And that gets to the sales practices and the employee training. The employees are trained. They're told, do what's in the best interest of the client with a wink. Because this industry, and we'll see this industry has fought hard against a fiduciary standard. A fiduciary standard says you must put your client first. This industry, and I would put this in your answers, so write this down. The fiduciary standard is you can only do what's in the best interest of your client. You cannot have other incentives in advance of that. The insurance industry and much of the investment industry does not like the fiduciary standard. They want the suitability standard. And the suitability standard says you have to act for your client in a way that someone else in a similar situation might have recommended something similar. So it has to say, could you imagine someone in some world buying this product? That's your only standard. It's a very weak standard. You don't have to put your customer first. If there's another company selling this product to a client and it makes sense, and you have a product that is horrible, it's poorly overpriced, poorly structured, but it's the same product another company can sell, and you can rationally argue that that company should sell it. The fact that your product is horrible, that doesn't come into the consideration at all. All you have to do is say, is this type of product is suitable in some construct for this customer? It's a terribly weak standard, but this industry has fought hard. Why? Because how do you put your customer first if you're paying your sales agents $500 to sell product B, but only $50 to sell product A? There's almost no way to set that up. Now, I've talked to some life insurance agents that say our company's different. They teach us, they tell us, make sure you put the client first. I still say you can tell that to the sales agent, but you tell the sales agent, put the customer first, but now you got to choose between that customer and feeding your family. That is a conflict that sales agent will find some way to rationalize that product B is in the best interest of their customer. Why? Because they get 10 times more money to feed their family if they sell that product. So I don't think there's any way to get around this. I much prefer, that's why I really loved USAA, where they pay their life insurance agents, or actually salaried employees, pay them a salary rather than commissions. If they're moving to more of a commission-based approach, I think that really destroys one of the benefits of USAA, which is the trust factor, that USAA has gained a strong trust over the years. And so there's fewer and fewer companies that I say I can trust, and there's some that I can definitely tell you I do trust a lot. There's a lot of companies I do not trust whatsoever. If you want to get more into this, I have a blog. Just type Professor Sweet Musings and look for the word beware. Beware of I forget the term I used after beware, but just beware of this industry, and I go on this in quite a bit of detail. And it might actually help you in answering this question on the exam if you want more detail. All right, so Sales practice, training, there's a wink, do the right thing, but then there's a wink. The next thing is, because these products are so complex, I have the word difficulty. We should change that word to the impossibility. Some of these products are so complex. I think even Albert Einstein even quoted that these products are too complicated, that he can't even understand them. Some of these products are beyond comprehension. In my blog, I talk about the kind of questions you should ask so you can compare these products. I just know if you ask those questions, the sales agent will not be able to give you that information. And essentially what I say on these products, and you'll see it, we're going to actually do that in this article on equity-linked annuities, is show me a large range of scenarios. So you say this product gives me these type of interest rates, give me these type of stock returns, then show me 100 scenarios of different stock markets, different interest rates, and show me how this product does versus very simple traditional products. And we'll get into that. So you cannot compare these products because the industry just does not have the information and they don't want to show it to you. I've got a product right now I'm working with my family that unfortunately my parents bought. It's a really horrible product. And it is so complicated. If I wish she had asked me to sit there while they were being sold this product, because I would have asked those questions and it would have put so much pressure on the sales agent. They would have ended up selling my parents the product. The product my parents needed was a very traditional whole life policy. Instead, they bought a very complex product. They did not buy the most complex product or even think anything close to it, but they bought a product that was entirely inappropriate for their needs. But there's no way that they could compare that to another product. Even the same product at another company, they couldn't compare it. There's just too many bells and whistles. We'll get into that and why these products are just impossible to compare. And so that sets up, as we said, information asymmetries. Why would my parents are smart people, why would they buy such a horrible product? Well, because the sales agent is talking to them like it's a simple product, like they should understand it. So you play on people's ego. No one wants to say, I don't understand, I don't know what you're saying. So the sales rep talks about, yeah, this is really great, you understand, see why they'd be so good for you. And most people will say, yeah, I see what you're saying, when they really don't understand. And since the sales rep understands it better than the customer, they can push the hard sell. Now, I will say the sales rep understands it better than the customer, but I will say some of these products are so complex that the sales rep themselves do not understand them. So these are complex products, but they do know more about it that they can make a hard sell. And that's why you see some of these lawsuits, and we'll talk through some of these lawsuits here. The next thing I really hate, and when we get into the Donya story, you'll definitely see this. When sales agents sell these products, they push the tax advantages. And the reason they do that is that's about the only thing this industry has over the investment industry. The life insurance industry has huge, huge tax advantages over other industries. And so what they do when they sell the product, they push those tax advantages without explaining the complexity, the tax complexities of these products and the other complexities. You have to realize when the IRS gives these huge tax advantages, they do it at the expense of liquidity. These products are very difficult to get out of. The tax penalties can be terrible, moving from one company to another company. You're often either stuck with the product or you have to get out of it and bear really horrible tax penalties. So these are terrible products on the other sides. But this is what this industry does. This is not in here, but you need to get this in your notes. They oversell the tax advantages at the sell point, but later in the product, when the tax problems come up, they tell their clients, we don't give tax advice. Now, they get plenty of tax advice when they sell the product, but later when the product blows up and there's all these kind of problems and the person says, well, how do I fix this without a major tax penalty? Their standard issue is consult your tax attorney. Now, I'm going to argue if the answer 5 years later is consult your tax attorney, I'm going to argue that today they should tell the client, if you have a problem with this product, you will need to consult your tax attorney. 99% of their clients will say, I don't have a tax attorney. And that right by itself should say this product is not suitable. I'm even using that term suitable. this product is not suitable, if there's a chance they're going to need a tax attorney to get out of this product and to manage this product, and they don't have a tax attorney, I would say this is not a suitable product. So, but boy, they have no trouble selling the tax advantages at the point of sale. But later they have no problem telling the person, hey, not our problem. You should have thought about that when you bought the product. So you have to ask, is this a really good product versus less complicated alternatives? And here's what you want to put in your answer, this concept of stochastic dominance. If you run a large number of simulations, I mean hundreds of them, stock markets are up, stock markets are down, interest rates are down, and they stay down for a long time, which is where we are right now, which is where the product my parents bought is blowing up. They bought a product that was offering a really high interest rate. The only problem was if interest rates fell and stayed low, that product was going to be a disaster, and now it's a disaster. We're trying to figure out how to handle that. So run hundreds of scenarios and look at how this product does versus others. When we look at the equity-linked annuity, we're going to find that it underperforms well over 90% of the time. And the small percentage of time it does outperform, it only outperforms by a very small amount. It's a horrible product when you look at the full range of distribution of what this product does versus other products. Before I get into Donya's story, so there's your outline. You need to write this out. I would recommend, we'll talk in class as we get ready for the exam what the exact question is, but it essentially is writing out in words everything we just said. You might want to go back and listen to this again and stop it and pause it and write out your answer and put it into your own words. You might want to read my blog on the industry. I'll give you the link to that here pretty soon. In fact, this is a good time. Why don't you pause the video and go get something to drink or eat, take a quick rest, and we're about halfway through the class, and then I'll go get you the link from my blog and you can watch that. All right, so here's my blog, The Financial Services Industry Buyer Beware. So here's the blog. You can write it out. I won't read it for you so you can see it there. Write that out. If you want to read through that blog, I do recommend it, especially if you're interested in this industry, because I talk some of the stuff I think give quite a bit of the Donya story in this blog. So I would go to that blog and maybe get yourself some stronger arguments than what I've done already, and see what I think about this industry. And here's the blog. It covers not just the insurance industry, but also the investment industry. There's a discussion about fiduciary standard versus suitability standard. And it goes through, it's a long blog. I don't write short blogs. And some of it is more focused on investments than this industry. But at the very, very end, I do give you what can you do? How can you protect yourself? And I give you 3 things to watch for. My recommendation is, start with if they're selling on commission, then stop right there. Don't even go any further. But so I even talk here. I'll talk about the equity-linked products in here as well. I talk about Donya. So there's a lot in there. Sorry it's so long. I get so worked up about this. This is one of my soapboxes. Now one more thing I want to do before we do the Donya story is just give you an example of, to show you that I'm not making this stuff up, the insurance industry and its sales practices. There's an article from 2013. This guy wins the lottery. So he won half of a $336 million lottery. So what do you do with that money? You would think, well, buy a house, buy a car, put some money in the stock market, maybe put 50 million of it in the stock market. Put money away for your kids' college, make it tax advantage. Maybe you'll give some to charity, give quite a bit to charity, maybe even start your own charity. There's a lot of things you can do. What about life insurance? You might say, why do I need life insurance? I just won, $160, $170 million, maybe after tax, not so much, but maybe $100 million bucks. What should I do with that money? Well, this is a young guy. He's unmarried, no children. What did he do? He put $100 million into a life insurance policy. Now he's suing the advisors who sold him the policy. They encouraged him to assume tens of millions of dollars in debt. So not only that, they got him to borrow money. It's just amazing. Here's the guy's name. He won the lottery in 2009. He took the lump sum, so he netted about 70 million. So yeah, taxes cut a lot of that out. And probably the 336 was an annuity, and he took the lump sum instead of annuity. So in present value terms, it's much shorter. It was still $70 million. So he hired 2 financial advisors. That was his first mistake. I don't know if y'all have heard Tim Duncan sued his advisor, not because of life insurance, but of some bad investments. And oh, how I wish Tim Duncan had called me. I would have done all of his investing for free. I would have just gone to Vanguard and indexed the whole thing. It wouldn't cost him anything. He would probably have 3-4 times more money today than he has. I would have done it for free just to say I was managing money for Tim Duncan. Would have set me up for a good career. But no, he didn't do that. And why didn't he? You know, Tim Duncan's a smart guy, but he just assumed, which is, I think, a fairly logical assumption. If you got a lot of money, then you can hire the best in the business, and the best in the business are probably the most expensive ones. So he hired a high-cost financial advisor. That's just not true in the industry. Paying more in this industry does not give you a better product. This is not a Ferrari. This is not a Tesla. This is something very different. In fact, spending more may actually give you a worse product. So they were financial advisors, attorneys, and insurance agents. Man, that's like the triple whammy of negativity there. So convinced him to buy 4 policies from 4 different companies, saying he could earn $50 million by the time he was 50 years old. There's no way you're going to earn money if you're buying life insurance. It's just not possible. So this industry, you can't earn more than you can in others. Remember, this industry is charging you more than others industries. The only advantage they have is the tax side, and the tax side on the life insurance is when you buy the life insurance, so when you die, you get the tax advantage. The tax advantage of other products is on the annuity side. So may make sense to do an annuity for the tax advantage, but a life insurance, no way. The agents made millions of dollars in commissions. They say 1 million here, but I bet it was nothing more than that. They exploited. So here's that asymmetry of information. They exploited the fact that he knew nothing about life insurance. And so he had no need for insurance. He had no chance of benefiting from the policy because he wasn't the beneficiary. So 2 years later, he says the defendants attempted to persuade him to exchange the existing life policy for a single $600 million policy. Again, yeah, $600 million, that sounds like a lot, but he doesn't get any of that if he dies. They got him to borrow money to invest in real estate. I mean, he just do some really stupid things. Now, why would they encourage him to do this? Well, this is why. When they got him to buy these 4 policies, they got a commission. Guess what happens when he exchanges these policies and buys this next policy? They get an entirely new commission. This is called churning. It's illegal unless you have to convince the regulators that it was in the, there was a need for the customer for you to do that. That's one of the reasons he made a strong case for suing. So he learned that his policy was highly unsuitable. There's this word suitable, and that's probably where his lawsuit is to say, no reasonable person would have bought this policy. So the agents, their defense is going to be they can conceive of some situation where this would make sense. That's all they have to do because they don't have a fiduciary relationship. And they were found in a way that would have provided him no benefits and make him liable for all types of taxes. So he paid $2 million in premiums. He's seeking damages for breach of fiduciary duty and professional negligence. I wish I could see whether he won or not. I should go back and look that up. I don't know. It's probably one of those things where they settled out of court, and who knows if his agents even have any money at all. So he can't really sell the insurance companies because these agents are not agents of the insurance companies. And the insurance companies could probably argue they didn't know all this was going on, although I even question that. So, yeah. So let's get into the Donya story. So this is not the actual Donya. I don't have a picture of her. I think she's passed away by now. This has been several years. But so just to give you an example, and you could work this into your answer, I think, very, very well, because her story, Donya's story, emphasizes practically every single thing on that list. So let's go back to that list. And as you see the Donya story come through, you'll see it. So the pastor at my church called me. I do a lot of pro bono. So he called me and said, I've got another situation, Ron. There's an elderly lady in the church and something blew up on her life insurance and she doesn't know what to do. She's in tears. She has this huge tax penalty. Normally for Donya, her taxes, I actually did her taxes after this. I told her I don't do taxes, but she talked me into it. Her taxes historically, she paid practically nothing in taxes, maybe a few $100s, because she really had no income. And it's a truly amazing story. This lady, her husband died very early in her marriage. She had a son. She did not have any really good education, but she just worked hard, and she actually saved up about $100,000, which is really impressive, giving her very low income. And I was shocked doing her taxes how low her income was. Definitely not a wealthy lady, but she saved up $100,000. And what did she do? She came in contact with a life insurance agent. And he sold her two products. One was a deferred annuity, which actually was a pretty decent product. It was a company, I'll try my hardest not to mention the company, although I'm very tempted to mention them. Very large insurance company in New York. It's the name of the company doesn't start with the words New York, but a large company in New York. Very large company. And has really good products, actually. They're deferred annuities. We'll talk about deferred annuities, but it was actually probably not a bad way for her to save her money. She didn't know anything about the stock market. She didn't know anything about mutual funds. So nice, safe, low risk product annuity. She obviously would have been better off with the annuity during this time. The stock market was up quite a bit, but she bought an annuity. So that's okay. Tax advantage, tax deferred. The other product they sold her was a universal life policy that she did not need. Her son was already out on his own, taking care of himself. She had no estate, really, for estate taxes. That was not an issue. She did not need life insurance. So one product they sold for her was probably a decent, good product. The other one was completely unacceptable. So what her agent did was she turned 70. When you turn 70, you have to annuitize these products. The IRS rules require you to do that. And so her agent told her that. And so what he should have done was annuitize this, which means start paying it out to her in monthly income. And she would have gotten a really good income, would have been really beneficial to her. She would have paid some tax on it, but not enormous amount. So what they would have done is the IRS, they look at the annuity, and your insurance company can set this up for you to pay out whatever the IRS requires to be paid out. And they look at your life expectancy. There's actually a table at the IRS that tells you how much of the annuity you have to pay out in a year. And that is taxable, not 100% taxable. Some of it was money that she invested, so that's her money, but the interest and earnings on top of that, that's taxable. So she might have incurred, a few extra $100 in taxes, but she would have had her annuity. What her agent did was he took that annuity and he surrendered it and put it into another product. Instead of just annuitizing it, he surrendered it. Well, when he surrendered it, that entire annuity became taxable that year. So instead of incurring a few extra $100 of taxes, she instead incurred $10,000 in extra taxes all in 1 year. She didn't have $10,000, so she went back because her agent sold this product and bought another one. So he got another commission. You can see the sales commission argument here. Rather, if he annuitized it, he would not have gotten anything. Instead, he sold it and bought another product, and he got a big annuity, a big commission out of doing that. So she goes back to him in tears and says, what do I do now? I don't have money. I can't sell the product you just put me into because then I'll incur tax penalties. So he sold some of her universal life, and guess what that did? That incurred more tax penalties for her. So even more tax. So she comes to me in tears and says, what do I do? I've got $10,000 in taxes and I don't have $10,000. She wanted to go see her son in Hawaii. She had not seen him in years. She was not a Zoom user. She probably just talked to him on phone. She wanted to go see her son. And I'll tell you the story of the son. She didn't know this at the time, but her son actually ended up dying from cancer just a couple years later. I met him once. He actually came to San Antonio and he gave me a hug and a handshake. He was so overwhelmed that his poor mother had gone through this, and he was glad that there was someone there to help her out. But she wanted to go see her son, and she was going to have to cancel that trip. Can you imagine her canceling that trip and missing out on that opportunity to see her son, a couple more times before he passed away? But she was going to cancel the trip. She was so upset. So I went to the sales agent and sat down with him, and I said, what did you do? And then I pointed out to him, why didn't you just annuitize it? That would have been the obvious thing to do. She would be set for life. She'd have a nice little income. You should have just annuitized it. He said, it's not my fault because my company, and I almost said the name of the company, my company did not train me well. He said that in front of me. It was his company's fault for bad training. Now, I talked to several financial planners after that, and they all said, he's lying. Everybody in this business knows how to handle this. We handle it all the time. It's very straightforward. They were just shocked that someone would have been that incompetent. So I drafted a letter. So you can see all the things going on here. Hard sell based on commissions, conflict of interest, bad training in that case. There's no way she can compare and shop. She didn't understand this product at all. She was at his mercy, information asymmetries. Guess what the company told her when she said, I don't know what to do, is he told her, we do not give tax advice. Consult your tax attorney. Very, very frustrating. I mean, your blood sugar should be boiling right now for this industry. So your actuaries, you're going to work in this industry. I'm just setting you up. This industry, you need to ask a lot of questions. That's why I talk about these lawsuits against this industry, these class action lawsuits. There are certain things you can look up. I'll talk about one of them later when we go through some of these products, some terms you can look up, like vanishing premiums and other things where the insurance industry has really been sued. But that was their argument, and so I wrote a letter to the president of this company. And that's what you always do in these situations. They're called presidential complaints. They have a special department just for our presidential complaints. Now, they actually didn't do anything with my letter, so I called them, and they actually admitted on the phone that they ignored the first letter, which is really, really horrible that they would do that. I'll just tell you this company, I won't give their name, but this is a company that had a huge lawsuit. They lost hundreds of millions of dollars. And as part of the lawsuit, it was discovered that they were shredding documents to try to hide, which is illegal. And they got in a lot of trouble and ended up being a really serious lawsuit. This happened before this situation with Donya. So this company already had a reputation for doing horrible things to its customers. And here they are again. So I called them, and here they are telling me, we ignore your letters, mail it again. So I mailed it again. And then I talked to the lady, and she said, this is what they told me, we will give her $10,000 back. So they agreed to reimburse her. I came up with the $10,000. Her actual tax bill was like $8,000, but I was worried that if the company gave her $8,000, that would be taxable, and she'd have to pay tax on that. So what I did is I asked for enough money so that if what they gave us was taxable, she could pay the tax plus the tax on what they gave her. It ended up that was not taxable. She never had to pay tax on that. And so it was kind of like a judgment or something. I don't know exactly how they did it, but it was tax-free. So she ended up actually getting a little bit more money than she needed, that was fine with me, given how they ripped her off. And so she got her $10,000 back. But they told me on the phone, this lady told me the only reason they were giving her that check is because the sales rep admitted in my presence that he was poorly trained. They said if he had not said that in front of me, their argument would have been, they do not give tax advice, consult your tax attorney. Now my argument was, now the only way they would give her the $10,000 is she signed a letter admitting that this company had never done anything wrong to her, that she could never sue them for anything. And I didn't want her to do that because I thought she could sue them for selling her the universal life policy. I really thought if she went to court and sued, she could have gotten a lot of money, especially for a company that's already had serious problems with this. I thought they had really done her horribly wrong. And the only way they could get she could get her money is if she signed this letter. So we actually went to a pro bono lawyer. These pro bono lawyers that help these senior citizens without much money. And I don't know if you want to guess what this lawyer told her, but this lawyer told her, hire a lawyer. That was his only advice. And I'm like, right, this is great. You go to a lawyer to get advice, and his advice is go pay for legal advice. I did not want to give her advice. She kept asking me, what should I do? What should I do? I told her it was her decision. She finally said, I'll take the $10,000, sign the letter. I'll just be done with it. Now it's possible she could sign that letter and still sue them, just because under duress, the lawsuits take forever, and she needed the money. So maybe she could have, but she just wanted to be done with it. She got her $10,000. So I felt good that, at least she wasn't worse off than she was. I was still upset that she had that universal life policy. It was so horrible. But just to tell you, I'm not exaggerating this. I'm not making this stuff up. This industry does terrible things. And I'll tell you another story. There's another time I was asked to help a lady in my church again with the life insurance policy she bought that was terrible. And I'll give you her story when we talked specifically about that policy. But just it's terrible what this industry does to people. So if you're so worked up now and so upset, and Donya very much looked like a sweet little lady like this, just such a nice lady. I would have loved to go into court and have her be on the stand and testify, and she would have been an incredibly emotionally effective witness. I think I would have probably harmed her because I would have gotten so belligerent and so upset. Her lawyer would have had to practice with me quite a bit. But terrible story for what this industry does. They ripped her off. They ripped off another lady in my church. They ripped off my parents. They ripped off this good friend of mine. It's just story after story. But this industry does sell good things. It does have really good products. We will talk about them. But I really think that sales commission is the disaster for this industry, causes all kinds of terrible, unethical behavior. So let's get an example of that. We won't be able to finish this, but we'll get into this. We are going to talk equity-linked annuities in much more detail later in the class. You are actually going to do the mathematics behind an equity-linked annuity. So I want to focus right now not to be on the mathematics on this. There's a lot of math in this article. This is an article that's on Blackboard. I'm just brought a few sections of the article in, and I want to go through some of the highlighted sections. So you're probably already mad enough now with Donya's story. I want to make it even madder with this industry. I hate equity-linked annuity products. I think they're a horrible product. Yes, I did in fact tell my insurance company I will resign if you sell this product. That was obviously, at a time where I had already announced my retirement, so I was going to be gone anyway. But their argument for selling this was USAA. USAA is a fairly ethical company, although I'm worried about what they've been doing here recently, but fairly ethical company, I think much more ethical than the vast majority of this industry. But his argument was, our equity-linked annuity will be better than the competition. We will not rip our customers off as much as the competition. And my argument to him is there's no way to build a good product. The expenses are so high, there's no way to build a product. Their argument was, this is such in high demand, we might as well give them a bad product that's not as bad as the competition because they're going to buy it from them. And I don't buy the argument. I just thought USAA should never sell a bad product, even if their customers are demanding it. So let's talk this product. It's a good example, and you could work some of this into your answer on the exam as well. So this is a good essay answer you can start working on right now and come to me and show me your answer and let me know, and I'll let you know if there's something major missing from it. I'll even give you the rubric for the answer before the exam so you can start working on it. And the rubric, I think, is out there on Blackboard. So equity-linked annuity, this isn't something the insurance industry invented. The insurance industry did not invent this product. Banks actually had equity-linked certificates of deposit before this. It just didn't work. It was bad timing. The insurance industry just happened to hit this product at the perfect time when the stock market was up a bunch. So equity-linked annuity, their sales have soared. Even though these are the most complicated products there are. Really, truly complicated. They're regulated by the insurance commissioners. They're not regulated by the SEC, even though they really, truly are investment products. There's been a lot of attempts to make these regulated by the SEC and classify them as investment products. And there's one point where it looked like it was 100% sure that was going to happen. At the last instance, the industry fought hard and got that kicked out of the legislation, and so it is still not regulated by the federal government, only by the states. This article estimates that 15 to 20% of the premiums on these products is really just a transfer of wealth from unsophisticated policyholders to insurance companies and commissions to their sales force. Now they take insurance, and this is for not just equity-linked annuities, but this is somewhat what we're talking about, the complexity. Insurance companies put really small insurance benefits onto horrible products. Why? Well, they don't want to be in the insurance business anymore because they don't make money there. They make money as asset gatherers. So they create products and they put small, trivial insurance benefits on them so they can say, oh, this is insurance. This is not investment. We're not doing any investing. We're not investment companies. We're still insurance companies. See, there's a little bit of insurance there. They give horrible tax treatment. We talked about that. The tax treatment's great if you hold on to the product for 30, 40 years. Otherwise, it's horrible. Extremely high cost. They charge fees on top of fees. So they put their clients into funds that have really high fees, and then they charge high fees on top of that, and they sell them. So here they're complaining about variable annuities. We'll talk about those. So what they're saying is, as horrible as that product is, they're now doing that again with this new product called equity-linked annuities. We'll talk about why variable annuities are so horrible. But equity-linked annuities, I think, are even worse. So, and they're doing it in a way. Now, variable annuity products are regulated by the federal government. They are classified as investment products. But equity index annuities are not regulated by the SEC. They are not regulated by the federal government. So they have a huge advantage. When you buy these products, you really have no idea what costs you're incurring. You'll see that here pretty quickly. It's impossible even for the people selling them to really understand them. Now, the people sell them, they do understand one thing. They understand the commissions. 10% or higher commissions. Much higher than what mutual funds and variable annuities get. That's why you ask, why are the previous slide I said these products are selling, the product sales are just soaring. Why? Is it because they're great products? No, it's because they're great commissions. And you sell where you make the commissions. I just know that. I know when I walk in the men's warehouse, I'll buy something that doesn't have a great commission on it, and when I walk out of the dressing room, the sales rep is holding 6 items that have great commissions on them, like ties. And I know, and I don't hold it against them. I don't say they're evil. I don't say they're unethical. I'm just saying that their employer has incentivized them to push certain items on me where they make the biggest commission. I am critical of life insurance because this is a financial product. They should have a fiduciary relationship, and they don't. So I don't expect that kind of behavior from car salesmen and suit salesmen, but I do expect that kind of relationship and fiduciary concern from an insurance company. It's a very different relationship when you're selling financial products. And in misleading market claims, we'll talk about that later. When we talk about equity-linked annuities, I'll get into the actual misleading claims. They're pretty horrendous. So again, it's a suitability requirement. So they have to go through that suitability, but that's actually a very easy standard. Now, some investment advisors are actually not selling these annuities because they're part of a trade association that says these are terrible products. Don't sell them. They're too complicated. They're too expensive. They incur costs that policyholder or the customer does not understand. There are much better products out there that are not as illiquid as this product. They have much better payoffs and are much easier to understand. So even some people selling this are saying, this is too messy for us. We're not going to do it, even with the great commissions we can get on them. All right, I'll finish with this slide, and I'll finish this in the next class. You can tell I get worked up about this. My heart rate's probably about 180, 200 right now. It just really makes me mad. So trade groups are fighting. They're urging their members to write these trade organizations, these regulators, to say, stop telling us to stop selling these. But there are some. I know I'm a member of the CFA, the Chartered Financial Analysts, and they hate equity-linked annuities. So there are trade associations that hate these things. They want to argue that, hey, this is insurance, it's not a security. We don't want the Security and Exchange Commission jumping in to regulate us. They say they are suitable. And I love this argument. Their argument is not all equity-linked annuities have horrible features. There are one or two of them somewhere out there that aren't horrendous. And that's probably another reason why I did not want USAA selling this product. You have a few good companies sell a product that's bad but not horrible, and you actually strengthen the suitability argument. So, yeah, there's regulators or trade organizations that say we will not sell these products, but there are people selling this that they love the commission. The insurance companies love the profits they're making off of these. No one's looking out for the policyholder on that side of the argument. So we'll finish this up, and maybe I'll get your blood boiling even more as we get into this.